So let me put up some of this. So when I say other intermediaries, there are two that are most significant quantitatively in the U.S. Okay. Pension funds and insurance companies. Okay, so this is about intermediation. If you look at the balance sheet of a pension fund, okay, what it, and you can, I have links in lecture notes to the flow funds, and you can see these links. But here it's the conceptual stuff that's important. You'll see they have these pension liabilities, which is the promised pension benefits here. Typical pension funds in 1960 were defined benefit plans, so they were promises to pay workers some fraction of their final income. So they're a long-term promise, and for the rest of your life, it's like an annuity. So pension benefit promises. Okay. And to hedge those liabilities, okay, they tended to buy long-term assets, in particular equities. Pension funds were a big holder of equities. Insurance companies, okay, have these sort of contingent liabilities, you know, these insurance policies. You know, if your house burns down, I promise to pay you. If you die, I promise to pay your spouse. You know, those sorts of things. Insurance policies on this, as contingent liabilities here, and as assets, they tended to be big holders of bonds. Okay. These are intermediaries. Between who? Well, who are the these are households who are on the other side there, right? Pension benefit promises are promises to households. And here equities, okay, these are liabilities of some business somewhere, okay? So this pension fund is standing in between business and households, just like Bagehot's Bank that we were showing there. Same with the insurance company. These bonds are issued by some corporation somewhere, okay? And these insurance policies are to the benefit of some household somewhere, fire insurance and so forth. So they're intermediaries also. Not like banks. This isn't money. These are insurance policies, right? This is their pension benefits, but they're intermediaries, and they were getting very large, and they are very large today, accumulating these kinds of assets here, equities and bonds. So they were very big in funding American development. They became very big in funding development, more so than banks. Okay, so that the importance of banks that Moulton was emphasizing in 1918 became relatively less important later on because there are these other intermediaries that are doing this. Gurley and Shaw are emphasizing in these chapters, circa 1960, the importance of intermediation of this kind and also of the banking kind for economic development in the United States. And what are they emphasizing? They're saying the problem that these institutions are solving is the following problem, okay? That the kinds of assets that households want to hold, the way they want to hold their wealth, okay, is different than the kind of liabilities that businesses want to issue. You know, businesses want to borrow for a long time, households want to hold money, okay? How are we gonna have any development like that? If the businesses need to borrow for a long time in order to finance the capital development of the nation, and households really insist on liquidity, how are we gonna ever finance the capital development of the nation? Bingo! Let's have an intermediary that faces both ways. It says to households, I'll give you what you want. Okay, you want monetary liabilities, I'll be a bank, I'll have deposits. And face business and give them what they want. Okay, you want 10-year loans? I'll give you 10-year loans. Okay, and similarly here, households want insurance. Okay, households want pensions. Fine, let's give them what they want. Okay, businesses want to issue bonds. Businesses want to issue equities. Fine, we'll give them what they want. Okay, so the image, the vision in Gurley and Shaw is that this indirect finance is key for economic development, because otherwise otherwise this disjuncture between the desires of households and the desires of businesses could get in the way. If businesses had to issue bonds directly to households, they couldn't sell them. The households wouldn't want to buy them. This is what they're thinking circa 1960. They don't have so much of a liquidity problem. So the question is about the liquidity problems of pension funds and insurance companies. These policies have actuarial quality to them. That's the idea, that not everyone's house is going to burn down at the same time. And these bonds you can sell these bonds in market liquidity, right, if you need to. So if there's a hurricane, okay, and a lot of these contingent liabilities come into the money, okay, then you have to sell some bonds in order to pay off the insurance policies. So that the liquidity of insurance companies depends on the liquidity of bond markets to be able to sell them. And here, the same is sort of true of equities, but you're thinking about the equities typically they're investing in equities up until the point in which the pension actually, the person retires. And when they retire, they convert some of these equities into bonds. Basically, they create an annuity. So annuities, and they run this through an insurance company typically, so that they'll turn it into bonds essentially. An annuity is sort of like, it's natural to fund an annuity with bonds because of the coupons are like the regular payments that you make to the annuitant here. But it involves, again, market liquidity. If you couldn't sell these equities and convert them into bonds, you could never do anything. So market liquidity is key. Shiftability is key, okay, for these intermediaries, just as it is for the banks, okay, as Moulton had said. Moulton, by the way, became president of the Brookings Institution, so I think this is one of the reasons that Brookings hired Gurley and Shaw. This is a continuation of this American tradition of thinking about banking throughout the 20th century. All right. This way of thinking, okay, that indirect finance works, solves a problem of development because it gives both sides what they want and you stand in the middle. This way of thinking has one problem to it, okay, one big problem with lots of little symptoms of that. But the big problem is this, that the risk, okay, of your assets doesn't go away just because you promise somebody some other kind of liability. Somebody has to bear the risk. It doesn't go away. It either goes onto your liabilities, or if there's some guarantee of your liabilities, the person who guarantees those liabilities is the one taking the risk. That would be the government, okay, typically. And if you don't appreciate this, okay, finance and arbitrage will make you appreciate this, okay, because you will be mispricing things. You'll be imagining that somehow you can guarantee benefits, okay, with even if you have risky assets here. That's not actually possible. If you have risky assets here, then there's risk that you're not going to be able to pay these benefits, okay? And either that risk is shouldered by the sponsor of the pension fund, some particularly corporation somewhere, often these were corporate pensions, or the government through the Pension Benefit Guarantee Corporation, or by the pension beneficiaries themselves, that these promises are made and then they're not kept. Okay, that's bearing the risk. So the risk doesn't go away just because you don't tell these people what their pension benefits are being backed by. Okay, the risk is there. Okay. The evolution of intermediation in the United States since 1960, which you probably know about, okay, has been to a hollowing out of this sort of indirect finance and much more direct finance through mutual funds. Okay. So we have stock mutual funds, which hold equities, okay, just like that. But instead of promising particular payments, okay, they just give you shares. You know, if you have shares in Magellan at Fidelity, okay, you have a share in a portfolio of assets, and if those assets do well, you benefit, and if they don't do well, you don't benefit. So you're bearing the risk directly. The risks pass right through. That's what a mutual fund is. It passes right through. This is like direct finance, even though this is sort of an intermediary in the sense that there's businesses on this side and there's households on that side. Okay, there's no actual risk shifting or anything. The risk is just passing right through. And similarly, bond mutual funds. Bond mutual funds, which hold bonds and issue shares in that portfolio of bonds. Okay. This development had big influence on determining these prices and therefore the profitability of this kind of thing. As you know, pension funds no longer typically offer some fraction of your last income. What they give you is a 401k, which is basically that. Okay, if you have a defined contribution pension plan, this is what you have. Okay, you are realizing the risk. You see the risk. You see, well, how many shares you have in Magellan, how many shares you have in PIMCO's bond fund or something like this, just to name two of the largest companies. This is not investment advice. Okay, I'm giving you. The rise of finance. The rise of finance as a set of ideas, okay, has been about the replacement of that system with this system. Indirect finance with direct finance. Intermediaries that promise different things to different people with mutual funds that promise the same thing to both sides, okay? Indirect finance is solving mismatches with quantities, right? By putting them on its balance sheet, by expanding their balance sheet. Mismatches in what lenders want and what borrowers want, it's solving with its own balance sheet. Modern finance solves it with prices, okay? You don't want to hold bonds? Well, bonds will just have to fall in price until you do want to hold bonds, okay? You don't want to hold equities? Well, equities will just have to fall in price until you want to hold equities, okay? So the modern financial system, price is doing a lot more work, okay, than it used to in 1960. Price is doing a lot more work. That's why everyone is focusing, right, on what happens to the stock market whenever some little blip happens. I'm giving you this so that you're now ready to think about banks as intermediaries and the evolution from traditional banking to shadow banking as being just like this evolution, from intermediation to this kind of direct finance here. The same thing that happened in capital market, okay, has happened in banking and in the money market. And shadow banking is really the natural evolution, the natural next step in that institutional evolution.